In this presentation, we will continue on with our comprehensive problem entering adjusting journal entries, this time dealing with depreciation for the year on equipment. For more accounting information and accounting courses, visit our website at accountinginstruction.info. So again, before we even get into what is depreciation and why do we need to record it, we're just going to go through our rules and say this is an adjusting entry dealing with depreciation, try to figure out which accounts are affected and which ones will be debited and credited. Then we'll discuss why we're doing this and what the adjusting journal entry is going to accomplish. So to do this, again, we know that the adjusting entry has one balance sheet account and one income statement account. We know that we're dealing with something related to depreciation. The balance sheet accounts are above the blue line, so something in here dealing with depreciation. If we look through it, how about accumulated depreciation? That seems relevant. It's got the word depreciation in it, so I'm going to say that's probably one. I'm going to right click here and highlight that yellow, indicating that that's probably one we're dealing with. And then we're going to scroll down to the income statement side where we have revenue and expenses, looking for something related to depreciation. And we have here depreciation expense. So again, that probably looks like the one we're going to deal with there. And we also know that income statement accounts only go one way. They go up. Expense accounts, they have debit balances. And to make something go up, we do the same thing to it, which is, in this case, a debit. So we know we're just going to debit depreciation expense. Again, we may not know exactly why. We'll discuss that in a bit, but this is all we need to know to really figure out the journal entry. So I'm going to scroll back up and say that's a debit and put that, I'm right-clicking and copying and putting that here in C11, right-click and paste values only. Now, if there's only two accounts involved and we debit the expense, we're going to credit the other side, which of course is accumulated depreciation. So I'm going to right-click and copy this. Put that on the bottom in cell C12, right-click and paste 1, 2, 3. Going to do some formatting, just indent this, go into the Home tab, Alignment Group, increase that indentation. Now we need to know the amount. So that's going to take a little bit more explanation. So note here that what is depreciation? This is probably one of the more confusing accounts when we first start learning this stuff. Notice we have equipment on the books. You would think it would be like supplies here, where we put the equipment on the books because we had not yet consumed it, we had not yet used it, we had not yet decreased the value through the use of it. Now we have. A month has passed. So you would think, like supplies, we would credit equipment, bringing it down to what we believe the current value is, and debit something like equipment expense. That would make sense. But the reason we don't do that is because, one reason at least, with supplies, this is how I imagine the reason. With supplies, we know it physically went down. We can count that there's less supplies. With equipment, however many pieces of equipment we have, we still have those pieces of equipment. It's not like they disappeared or anything. We know that they went down in value, but they didn't physically go down in any way, we believe. So that means that what we want to do then, what we're going to do is not decrease the equipment directly. We're going to tell our reader, hey, look, this is an estimate by creating this other account called accumulated depreciation. We're going to put the credit half, the decrease in value here, so our reader can then see, just by the trial balance, they can say, that's how much they paid for equipment. This is how much it went down by, the difference between the two being the book value. And then the depreciation will be the other side. Instead of calling it equipment expense, we're going to call it depreciation expense. Depreciation has to be on something like equipment, something that is a depreciable asset, something that is a furniture and fixture, or something that is property, plant, and equipment. Okay, so that's going to be it. So then how do we calculate it? Now, I'm just going to do a quick straight line depreciation. Again, depreciation could take a whole, comprehensive problem in itself. So we're going to say that it was for 1 month of depreciation. We're going to pretend that this full equipment amount is on the books for one piece of equipment that was purchased as of the beginning of the time period, the beginning of this month. So obviously in practice, we probably have multiple pieces of equipment and have to account for them individually as to when we bought them, what the useful life is. And again, that all gets into depreciation calculations. As far as the journal entry goes, we want to just get the form of the journal entry and see what the effect will be here, and then we'll talk about depreciation. We can discuss that at another time. But I do want to get just a quick calculation. So if it was one piece of equipment, 60,000, and we're just saying it's straight line depreciation, and we said it was 5-year property, divided by 5, we're going to say there's no salvage, by the way, that would be $12,000 a year. And here there's only 1 month that has passed. And again, I know we purchased it maybe a couple days into the month, but we're going to say that a whole month has passed just to keep it even. So we'll divide by 12, and that'll give us the 1,000. So we're going to say, just do that again. I'm going to do that with a formula in D11. This equals 60,000 purchase price divided by 5-year property gives us the depreciation that's lowering a value per year, divided by 12 months because only 1 month has passed. And that'll give us 1,000. We're going to put the credit will be the same, and there we have it. Now we're going to post this and see if it does what we expect it to do. What do we expect it to do? We expect it to increase accumulated depreciation in the credit direction. Very funny here because it's green, indicating that it's an asset, and assets all have debit balances, except this one, because it's a contra asset account, meaning it's an asset with a balance contra to the norm for all other assets. And the reason is because we basically broke out this income statement, this equipment account between 2 accounts. We should be putting that credit right here and decreasing the equipment directly, but instead we broke it out, and that's what really creates contra accounts. Rather than just putting it to this account, we wanted to give more detail and kind of broke out its own account. And then on the depreciation side, we expect the depreciation to go up because we have consumed the equipment, and the expense should go up, decreasing net income. So let's do that. Here's the depreciation expense on the journal entry. Here it is on our worksheet. We want to be in the middle column, the adjusting column, in cell I-23, where we will say equals. Point to that 1,000. Once we hit enter, it's going to bring the 0 up by 1,000 to 1,000, put us out of balance by 1,000, bring net income down. So there we have it. So we're out of balance, net income brought down, in net income calculated, revenue minus expenses. Then we're going to scroll up to the accumulated depreciation, that being the other side of our journal entry. We are going to be here in the middle column in cell I-11. Within I-11, we will say equals and point to that 1,000, bringing the 0 up by 1,000 in the credit direction to 1,000. So now we're telling our reader, we can tell our reader, look, the thing isn't just worth 59,000 now, kind of like we did with its supplies. We say, hey, we got 5,000 of supplies. No, we're given more detail now just with these 2 accounts. We say, yeah, we bought it for 60,000. We think it went down in value by 1,000. If you take the debit minus the credit, you get the book value, which we believe it's on the books for 59,000. And then we get the other side saying this is how much we've actually consumed. And that's similar to the supplies expense, which is we're just putting the other side here. That's how much we actually kind of used of the cost of the equipment. And that's going to bring up the expense, bring down the net income. For more accounting information and accounting courses, visit our website at accountinginstruction.info.